Sure.
Great.
Okay, cool. Give me a second. I'm just looking at my sound settings to make sure that I can see stuff. All right, cool. Wait. All right. So one thing that's weird. You can all hear me still, right?
Yeah, I can hear you.
Okay. My microphone tends to do weird things with me. So if midway through the presentation, you can't hear my speech, let me know. Just put a chat and I will edit my speaker. Something a bit crazy. So anyway, welcome guys. Good morning, good afternoon, good evening, wherever you are. Just by way of introduction, so my name is TJ. I run sales over at GSR for APAC and EMEA region. A bit of introduction about myself. I started my career in traditional finance. So I used to be at Morgan Stanley up in Hong Kong. I was on the structured derivatives desk in fixed income, did private wealth, moved to Nomura, did private wealth as well before joining GSR in mid 2020. GSR as a firm, we're one of the largest altcoin market makers on the street. Some people know it as market making, other people call it liquidity provision. And really, our approach when we look at it is to work with young projects, mature projects, and exchanges to talk to them and guide them in this journey. And the reason why is what we found in the market is that crypto is full of very young, brilliant technologists, but there is an entire element of the capital markets which they're not so familiar with. And we hope to be able to educate there. So, I mean, let's move into it. I've got some stats there, but we can talk about it later on. So what is market making? And I think liquidity provision and market making is almost like a dirty word in some regions because there is a lack of understanding. Uh, at the end of the day, for your project, and a lot of you who are coming up with token generation events, you realize that you will learn over time that the TGE that you do is actually only the beginning of your journey. So when you start your TGE, what it results in is your token is now live, it is now visible, but now there are expectations. It's almost a bit like going live with equity, if you think about it. But there are some key differences between the approach to market making in what we call the traditional finance sphere, as well as that within crypto. So within traditional finance, if you think what happens is traditional finance, say equities, it's a very regulated market. All the participants, all the market makers are held to the same set of standards. Not only that, but in traditional finance, let's say a stock that's listed on the S&P, it's only listed on the S&P. And so because of that, all market makers converge on the S&P. The liquidity is very thick and it's very easy to trade. Slippage is minimal. When we talk about slippage, what we mean is the ability to buy a decent chunk of an underlying and not cause the price to whip around. Crypto, unfortunately, unless it's Bitcoin or Ethereum or one of the majors, is the complete opposite. A lot of you in your journey, and we'll talk a bit about this as well, will have a lot of consideration. It will be things like which exchanges to list on, what's the timing, do I incorporate a debt, for instance. And a lot of these discussions, you should be able to have them with the market maker you choose to work with. As I've mentioned, today's discussion, I'm not here to show you GSR. I'm here to teach you about market making in general. But not only that, give you enough information that when you embark on your journey into the space, when you go and talk to the different market makers, and I'm telling you all now, you will all need a market maker. But when you talk to a different one, you will do so with a point where you are now, you have information, you're not lacking it anymore. You can have an educated discussion to know what you're getting into. So if you talk about market making in crypto, you have a few venues across the globe. It's almost like decentralized pools of liquidity. And because of that, a market maker's job in crypto, their focus is to ensure that there is minimal arbitrage between venues. The reason why is what you want your community and your ecosystem to experience is that trading your token, regardless of venue, feels the same. You want people to have that positive experience. If I buy the token here or I sell the token here, it should feel the same, regardless if it's a Binance, a KuCoin, a Coinbase, a Kraken, a Gate, etc. And that is something that can tend to be very, very important. What we also do as a market maker is we will work with token projects like yourself, or we will work with the exchanges. Some of the exchanges contract us to market make directly for certain pairs, but in general, we work with the altcoin community. So this is the most interesting slide that you're going to see today, and we're going to walk through the concept of KPIs later on. But really, what is the job of a market maker? Interestingly enough, it's in the title, market maker. A market maker's job is really to facilitate orderly trading. They do this by ensuring that there are both sides of the book at any one time. And when I say book, I mean the depth trading book. the bid side and the offer side. What they do is a market maker's job, if you think about it, is to insert levels in each side, the bid and the offer, at equal parts. But more importantly, the sizing of these levels and stack should be the same. The reason why is a market maker, first and foremost, should not be a prop shop. Their approach is to ensure that your ecosystem, your community, will be able to trade your token in a good way. What a lot of projects fail to realize, and this is where we see the biggest divergence, is a lot of projects expect market makers to almost be that last line of defense to support my price or to embark on wash trading to help me generate volumes. And let's be transparent, we're not in a magic show. We don't generate things out of midair, right? There's nothing generated out of there. There's a reason why certain things happen, but I'll cover the pitfalls shortly. Not only that, a market maker's job is to help you expand your reach of your token by distributing tokens into the market. They do this on the offer side of the book, if you think about it, because they're helping you sell tokens into the market and hopefully into the hands of more and more people so that your ecosystem branches out even more importantly as well. It's key that the market maker inspires confidence. This is done by having the right stack on a perpetual basis so people can look at your market on a coin market cap, on a coin gecko, go to the underlying exchange and see that they can trade this with confidence. The worst thing for a project is if you have somebody who, for instance, hears about your project, wants to buy your token, goes to the venue, because you don't have a market maker, there's actually no real liquidity to buy it or sell it. That's a very dangerous thing because you're off-putting people who want to get involved in the ecosystem. These are different trading venues. And the reason why the focal point, I'll talk about this very lightly, the focal point is centralized venues over decentralized. And the reason is, let's be realistic. I understand the concept of what DeFi stands for. And on a personal level, I'm a big believer in its theory. I think in practice, unfortunately, DeFi has failed to a very large extent, at least right now. And the reason why is individuals, human greed, right? DeFi is a perfect concept when you move people along that path. So literally speaking, what do we see in terms of DEXs? So starting off with the DEXs part first. DEXs are a way for projects to get further reach to users who are unable to, for whatever reason, do KYC or AML on an exchange, right? I know that we think DEXs are a way of removing the middleman, and yes, they are to an extent, but they're also a way, unfortunately, for you guys who are part of the project. This is where it becomes problematic. Imagine you have just done your token generation event. You haven't listed on a centralized venue, but you are in talks with a few centralized venues. But because of investors pushing you from behind, you're okay, I'm going to set up a DEX pool. You do so. Most likely, the first reaction of the DEX pool is people to start slamming the price. They're going to start selling into the pool, and the pool becomes lopsided. The problem you then have now is a centralized venue will now use this as a reference point in your exchange negotiation. We've had it at GSR where we've recommended to clients, for instance, not to do the DEX straight away, but because of a large investor on the side, they did it. And they were in talks with some of the exchanges on this list. The minute that they opened a DEX pool, unfortunately, their well started selling. What happened then was the centralized exchange literally turned around on them and said, we're going to observe you for a while now. We're not going to list you yet because of the price action of your token. What this means then is trading venues becomes almost like a lever that you can strategically pull. And the reason why is if you look at the exchanges here, let's be realistic and transparent about how the market is. Not all exchanges are created equal. What this means is your listing is almost a journey in itself. It is a strategy in itself. Do you start off, for instance, if you're able to get the Binance listing or a Coinbase listing? Or are you younger, not as hype, and you've got to start off on a Gate, on an MEXC, on a KuCoin, for instance? The question then is, how do you work your way out? When do you introduce the DEX pool? There are a lot of these questions which a market maker should be able to work with you and guide you as to the right thing. The market maker, if they're worth their salt, should also be able to make warm introductions to these venues. The one thing you should be very wary of as a project, if a market maker says that they can guarantee you a listing on a venue, that does not make sense. That is actually a conflict of interest if you think about it. The market maker's job is to make market, is to provide liquidity. It's not to make money from an introduction, if you think about that. So that's something that you have to bear in mind as you go along your journey. So what are the pitfalls to avoid when we talk about market making? And this is actually quite an interesting area, and it's an area that I mean, with my background in traditional finance, I'm very against a lot of the crap that goes on, unfortunately, in crypto, and it's something that we're trying to educate people about. So the first thing, the pitfalls from a market maker, and the reason why a lot of these pitfalls happen is the nature of market makers. Some market makers, unfortunately, are prop shops. And by being a prop shop, it's a very different approach to a market neutral market maker. But we'll cover what is market neutral shortly. So the first pitfall to avoid is unbalanced books and a selective presence. What I might mean by this is if you think about the bid and the offer, if you have a fair market maker, the amount they quote, let's say they tell you they're quoting $10,000 on the bid side, the offer side should be $10,000 as well. It should be equal books on both sides. The reason why is then what it is showing you is the market maker is neutral. The market maker, for all intents and purpose, should be price agnostic. They should not care if your price goes up or down. Their job is to ensure that the books are there for people to trade. Their jobs are to ensure that they are always in the book, which leads me to the concept of a selective presence. Some shops, unfortunately, especially the prop shops, what tends to happen is if the market is in a free fall, they tend to actually pull engine. The reason why is they're losing a lot of money by doing it. But that shouldn't be the case. That is the time, if you think about it, where you need your market maker the most. Not to defend the price as it free falls, but to help the price fall in an orderly fashion by having maker levels on the way down, to almost stem it in a gradual effect, reduce volatility, so to speak. The other two areas, and this one I'm going to cover very lightly, and I think it's an important point, wash trading. The number of times I've been asked by a project to, can we help them increase their volumes is ridiculous. And the reason why it happens is because they get a lot of pressure from exchanges to do so. Let's be transparent here. Wash trading, and I'm going to say it as a statement, as a firm one, wash trading is bad for a project. And I'll give you a live example. Let's say your project, and you're a young project, right? This is a data point. You're a young project, and what happens is you see that your organic volume today is maybe only $10,000 a day because you're young, right? Not enough marketing, etc. But what happens then is the exchange says, no, you got to be at $250,000 a day. Otherwise, we're going to do whatever to you. Then what you do is you go to your market maker or you go to a trading shop, they say, look, I need you to help me churn up to $250,000 of volume. Fine. You're now on CoinGecko and CoinMarketCap. It looks like $250,000 a day. But don't forget, your organic volume is still at 10,000. What does this mean? It means that let's say a whale comes in and looks at $250,000 and thinks, oh, I can actually sell $100,000 without doing too much to the market. And he puts in a 100,000 sell order. The problem you have is your organic volume is only 10,000. What do you think this $100,000 is going to do to the price of your token? It is going to completely obliterate it. Because the way wash trading works is it trades between the bid offer. And the problem then is when a real order comes in, those engines disappear. So wash trading is innately bad for a project. If anything, a project, you should use your volume numbers, even if it's low, as a data point, as an indicator. If you, for instance, tomorrow you make a strategic announcement and you see organic volumes going up, that's positive. That means you're on the right track. If you deliver on your roadmap that you promise your community, your volume should go up. Now, how would a good market maker help you increase volumes? It is actually by depth of book. And I'll give you an example. Let's say today you did a marketing campaign and there's a user who comes in and says, look, I want to buy $1,000 worth of your token. Right now, your market maker is only showing $2,000 in the book each side because your volumes have been low. The problem then is a guy with $1,000, I'm taking off half the book. That's quite a lot. But imagine if your market maker, for instance, showed a book of $10,000 each side. The guy comes in and says, oh, $1,000 is only 10% of that. Maybe I can even do $2,000 without moving the price. It encourages people. It gives them confidence to trade bigger sizes. Like I said, the market maker's job is to facilitate your ecosystem. It is not to be a layer of last resort. Price manipulation is obvious. From all my years on the trading floor, the one thing you learn is that trading is a zero-sum game, meaning that if someone is winning, somebody is losing. If the price is falling and your market maker is defending a price for you, eventually they're going to reverse that trade. And they're going to reverse it on your community. So the problem then is they end up trading against your community. This is very dangerous. It can kill communities. And the problem then is price manipulation, more often than not, result in the trading shop trading for themselves rather than for you as a client, which is more important. So this leads to that problem of unaligned incentives, where let's say I need to monetize by the spread, the bid ask, I end up having a wider bid ask. Or there's conflict of interest because I'm protecting my book versus what your interest is for your community. These are the problems that when you talk to a market maker, you should be able to get a sense of what is their intent and purpose. We're also going to cover shortly the different economic models you may come across when you talk to a market maker, and you will see how this actually transposes very nicely to that. So how do you select a market maker? Well, this is exactly like crypto. Do DYOR, do your own research, reach out to different contacts, reach out to projects, reach out to VCs, reach out to incubators, ask them who they would recommend. But don't just take what they ask you at face value. Have calls with these market makers, have conversations, because what may suit client A may not suit client B. And these are the differences that become very important. What we're actually seeing now, our regulators are actually focusing a lot more on projects and who their market makers are because of the concept of manipulation. So doing a reputation check becomes very, very important. Okay. So how do we identify when a market maker is present or not, and what is good and what is bad? I have here two order books of the same of the different tokens, but captured roughly minutes apart from each other. So the general market was the same. A lot of people would say, yay, the chart on the left is fantastic because there's so many bids in the book. But the problem is this is a lopsided order book. And I mean lopsided because even on the base levels of what the market maker is showing depth, it is lopsided. Not only that, the bid offer on this one is slightly wider. You can see the space between the green and the red is actually slightly wider than the chart on the right. A chart on the right is what we'd call a good order book. The reason why is it's different stacks. It's almost like a butterfly if you think about it, meaning that if I want to do bigger size, the price moves a little bit more, and you should expect that. That's normally how markets react. But the tight bid ask is very important, and the quotes themselves are very even. You can see charts like this actually when you pull up an exchange page and you click on depth. You should be able to see this, and it's a dynamic movement. But what you should be able to see is a general pattern over a period of time. So with all this said and done, then how should you judge a market? Oh, actually, let's cover this one very quickly. This is actually a CoinGecko page of a token. I'm telling you now that there are no market makers in the book for this one. And you can see this if you look at the plus minus 2% depth. There's no depth at all. Yet what's really, really interesting is that every single exchange is showing volume in the thousands. That's unrealistic. Because if you think about it, if there is no depth, but there's tons of volume, the price by right should be whipping around because there's no depth, but it's not. This price is almost like a straight line. What this shows you is that it's actually wash trading. Not only that, if you see the spreads between the different venues, they are vastly different. This means that if I look at this, I'm more likely to trade on one venue versus another. But then the problem is this becomes a point of friction for your ecosystem. Because what if I don't have an account with this exchange? And then I need to create one just to buy a few $1,000s of this token? They tend not to. So having a similar price across venues becomes all the more important at the end of the day. Right? So this is what we think. And honestly speaking, these are the KPIs in our mind that you should judge a market maker for. One is the spread, meaning the bid ask. How tight is it between the highest bid and the lowest offer? To give you an idea, if you look at Bitcoin, on average, the bid offer ranges from 2 basis points to 10 basis points. That is 0.02% to 0.1%. For an altcoin, it's slightly different, and it depends on market dynamics, how volatile. But it should be anywhere from 0.2% all the way up to 0.8, maybe even 1% in very, very volatile times. The tight spread is important. A good market maker understands market conditions and moves along with it, almost like a fluid wave. They must also ensure that there is sufficient size and depth on both sides of the book to enable the community to trade, the ecosystem to trade with minimal slippage. If you were to ask me, and based on experience, the most important KPI is that of uptime. Uptime is present. Your market maker ideally should be in the book more than 95% of the time. That's the most important thing. If the market maker is not in the book, then what are you paying them for, if you think about it? Their job is to be there. The presence, once again, becomes crucial. So what is the optimal model if you think about it as a market maker? Well, a market maker should profit by being delta neutral, as we call it. Delta neutral means I am no longer taking directional views on your token. Once again, if a market maker has a directional view on your token, you may think it's really positive because it's in their interest for your token price to go up. But let's be honest, that's not really in the interest of your project, because the token price should go up because of developments that you achieve. It should go up because of the ecosystem that you have built, the use case, the user, traction. It shouldn't go up because a trading shop thinks it should go up. There's a bifurcation in terms of intent. So a good market maker tends to be market neutral so that they can provide quotes equally on both sides, and they're price agnostic. Being price agnostic is very important because it means when the market falls, the book is the same. When the market rises, the book is the same on both sides. This means that they're price agnostic. There are costs involved in market making as you go on your journey. There will be onboarding fees, trading fees. Every market maker will have a different model in how they charge for these. Some don't charge at all. It really depends, but these are things that you need to ask as well. So what are the approaches? And this is probably going to be one of the most important slides, because what's going to happen is you are going to have discussions with so many different market makers. I think if you were to look at the big one, there's maybe 2 to 3 of us, but there are a lot of medium-sized shops. There's a lot of smaller shops in the street. And because of that, each one employs their own models. So let me run you through the models. Now, there is a biasness on our side. I'll be transparent here. We like some models more than others, but that's because of the nature of what the model ends up producing. So the first model from left to right is that of profit sharing. We absolutely hate this model. Profit sharing, literally, and I'll give you an example. Let's say your token price goes from $1 to $10, and the split is a 50-50. Then technically what it means is you make 450 and market maker makes 450. That may sound brilliant, but once again, I want to emphasize and echo something. Your project, your management team is not supposed to be making money from the daily trading of your token. You make money because you come up with a business that is able to drive revenue, that maybe along the way your token has done so well that you can release some of your own holdings. It is not day-to-day trading, because this profit sharing model, think about who the market maker is trading against to realize this profit. It is your ecosystem. That $1 to $10, at $10, who are they selling into? They're selling into your community. And if they're trying to realize a profit, they will be selling aggressively. So this is something to be wary of. We don't like this model. We tend to see it more from prop shops and a lot of the smaller market makers. The middle model is a bit more, I wouldn't say iffy, but I would say it's a bit more neutral. It's that of retainer model. What this means is every month you just pay the market maker a fixed fee and they go and do their job. This has pros and cons, right? On one hand, by paying a fixed fee, you know how much the cost is. There is no disalignment of interest of price. However, there are issues with the retainer model. Firstly, you are a startup. You have raised funds to build a product. You're paying a market maker cash every month in the retainer model. This is money that, if you think about it, could actually be positioned towards hiring, marketing, growth, product development. The retainer model also has another flaw. Let's say your retainer that you're paying your market maker is $10,000 a month, for instance, and I'm using this as an example. But let's say the market's extremely volatile and starts to drop tremendously. And let's say your market maker has now incurred costs of $15,000 on that month. Technically, the cost is now above what you're paying them. There is a very high incentive for them to just shut off their engines and pull their engine. That's the problem with the retainer model. So the model we're seeing a lot more from the larger market makers, and it's one even at GSR that we employ because we think it aligns strategies, is what we call loan and optionality. This model works on the basis where the market maker borrows tokens from the project. They borrow it so that they can show the offer side of the book. Remember, this is to help you sell your tokens into the market. The bid side of the book, the other side, should come from the market maker's balance sheet. By doing that, it shows that there is vested interest from the market maker. That's what you need. However, how a market maker will monetize this is this loan that they have borrowed from you. They would like the right to purchase it from you. This is actually, besides a way to make money, this is also a risk management method. And I'll give you an example why. Imagine if today you lent 1,000 tokens at $1 per token to the market maker. Imagine if after 1 year, your token is trading at $1,000 and your market maker has to return you that loan. That's $1 million if you think about it. If I didn't have the option to purchase it, I would be in the hole by a lot. So this is why that option to purchase is important. Now, depending on how a market maker risk manages that option, it is possible then to become market neutral, which allows them then to show equal books on both sides. But what affects and influences the approach to the market maker that you work with? Well, firstly, it's token economics, right? And your token economics, we're talking about the unlock, maturation. A lot of projects and exchanges love it when they see the the beautiful green candle of 50, 100x on day one. Transparently, that's probably not the best thing. And I explain why. Imagine if you are a product that's doing a TGE today. And imagine if your product's not even ready. Let's be honest, most products are not. Yet your token price is going up 50x. What's going to happen when you actually go live? Is there really a chance for it to go higher? That's something that you have to be worried about. Remember, a project, you should be in it for the medium to long term. Your job is to build an ecosystem in a community. Do so by building your product, and your price should follow hand in hand, as should your volume. That is actually the measure of success. So because of these, things like unlocks as well, when do they unlock? Well, normally what happens on unlocks is, yes, we do see massive selling pressure. If that is the case, you should work with your market maker so they understand it. And what they can do to help, for instance, is thicken the book on both sides. This helps a bit of absorbing, but it's also important because this is how a market maker works with you in your journey. All right. So I've actually come to the end of it in terms of what I wanted to cover today. I try to keep it as neutral and more fact sharing than anything. I will open it up for questions though, if there are any.
Yeah, CJ, this is Pat with the Alderverse team. Definitely appreciate your time today. I was going to ask you to kind of flip it around. I appreciate you providing all the projects, what to look for in a market maker. Just flipping it around, what do you as a market maker look for in a project to take someone on or not take someone on?
Yeah, sure. I think, so let me break it down for you, and a pleasure to have, thanks for dialing in. So it depends on the market maker. So if you are a prop shop market maker, they tend to look for projects which in their mind are pretty hype. They think will do the inevitable 20, 50x that they can monetize. But I think if you were to ask me, and maybe this is why I think in a way GSR is very different, it's a different approach. What we look for on our side is we look for projects where the founders, they have a clear vision of what they want to do, right? I think market making is a journey. If you think about your project, you will go over a life cycle, and your life cycle, the first part is going to be the go to market. The second part is going to be the maturation of your product. The third part is then going to be scalability. If you think about that journey, if you have a market maker from the very beginning, they will grow with you and with your project, and they will guide you along the journey. So as a market maker, there's a few things we look out for. One, we want to ensure the team knows for all intents and purposes what they're trying to do, meaning that the model they've come up with makes sense. We want to make sure that their backers are not unsavory characters. Unfortunately, within the VC space, and for a lot of projects you will learn over time, the VC investors you have can actually make or break your project, especially if there's a day one unlock and they decide to dump on you, for instance. It becomes very, very painful. So we want to make sure that you don't have unsavory characters. And actually, even at GSR, when we work with projects at whatever stage, and let's say they're trying to build a cap table, we will actually guide them. We will give them our thoughts on different participants, and we will even make the right introduction. And the reason why is crafting that cap table is going to be an important part to sustainability of success. Those are the things that we tend to look out for. I think besides that, a market maker really, our job is to be agnostic. And when I say agnostic, I mean sector agnostic. I mean layer one agnostic as well. And the reason why is within crypto, it's very different. I'll give you an example why it's so different from traditional markets. If let's say tomorrow Tesla delists its stock, well, he's still going to produce cars. He's still going to have a revenue model. They're going to make money still. But let's say if tomorrow one of the layer ones out there, their token stops circulating, that Lego one ecosystem slowly begins to decay and eventually will die. So if you think about a market maker's job, our job is to provide liquidity as a base layer to anyone who really needs it. So we don't show favoritism. We will work with all projects who understand what we are about and who appreciate our approach to doing it. The way to put it, I guess, is as a market maker, we look at ourselves as ethical. And because of that, we want to work with projects who the management team has the same mindset. A bit of a circular answer, but hopefully answers the question.
Yeah, that's great. Is there ever a need for a project to have more than one market maker?
I love your questions, man. And it's obvious, it sounds to me like you've actually begun your journey, which is important in this one. And my answer to that is yes, it's possible. The way I would divide up responsibilities in my mind in the right way is this. Look, a lot of projects, you need a market maker whose first job is to create your book. This is key, right? The books that people can trade. Now, some projects, however, they may have a treasury to manage for or investors to manage for. They tend to contract a second market maker to do that. At GSR, and I'm going to use GSR as an example, we have one request in this instance. I don't want to know who your other market maker is. I never want to be in a chat group with your other market maker because there are conflicts. So it's fine to have more than one market maker. And even for us, we've come across projects where there are 3 or 4 market makers. And technically the project will come to us and say, look, are you seeing the other guys in the book? What are you seeing in terms of their trading pattern? So we help them and assist them with something like that. So yes, it is a viable thing at the end of the day.
Thank you.
No worries.
Great question, Pat. Anybody else? Any questions? Victor from Nama Finance asked in the chat, like, how much should initial liquidity be provided for a fair launch project without any market makers to start?
Yeah, sure. So this is an interesting one. The concept of fair launches is something that it's not nascent in crypto, but it's still not as widely done. And the reason why is a fair launch is very dependent on how much interest have you managed to drum up from the community. Because if it's very segmented, then you end up with very large pools, right? What we've seen in terms of initial liquidity is, let's say, a total supply schedule. We normally notice that initial liquidity is anywhere from 10 to 15% of total supply. That's what we've noticed. I would say one thing though, for a fair launch project, you should try and figure out how to work with a market maker. There are ways to do it, and it's just as important, because if you think about the concept of a fair launch, you have the same problem. The minute that token goes into market, it's going to start whipping around. People are going to want to buy, people are going to want to sell. And unfortunately, because of how nascent crypto markets tend to be and how spread out liquidity is, you're not often going to find that matched buyer and seller. So having a market maker present is still just as important. But the nature of the deal with the market maker can be different for a fair launch.
That's interesting.
I mean, if there are no further questions, look, I can be contactable via Heidi and the team. At GSR, we've got a presence in Singapore, London, and New York as well. So we are across the globe. And feel free to reach out. But I wish all the projects well. I was asked to give you all homework. Transparently, there's no such thing as homework when it comes to liquidity provision. I think what I will maybe postulate to all of you to reconsider is really have a deep dive into your token economics. And rather than, and I believe there's a mentor who talks about token economics, but it does have a very strong effect on market making as well. Maybe look at your token economics from a standpoint of your roadmap. And this is something that's actually very important, because by doing so, the correlation is actually very important to how you would expect unlocks, price action, etc. And then not only that, the other thing, and maybe the homework I will give you, all of your projects, start talking to market makers early. A lot of projects think that they should only talk to a market maker when they're looking to list. A good market maker can be a very powerful ally from the minute you have just done your seed financing round, because they can guide you on the journey. Like I said, a good market maker's job is to guide you on the capital market portion of tokens, which is technically a massive part if you have a token. So that's probably the homework I will assign you guys.
Awesome. Thank you so much to CJ for sharing your experience. I know, most of the startup in a really early journey. So I think your topic today definitely will make them think about how to talk with market makers, and we would definitely share the contact. GSR is one of the major market makers in the digital asset space. So thank you so much to CJ, and thanks for your insight. And we will stay in touch. Thanks, everyone.
Yep. Thanks for having me.
Thank you.
All right.
Thanks.
Thanks.